Hi, everyone. I'm Doug Alsdorf, the author of Financing Your Future. This is chapter 15. I really want to encourage you to do this yourself. You are thoughtful, you're well-educated people, you are very capable of investing and doing your own personal finance. Oftentimes, people want to know, what investments do I actually own? So I'll show you those as well. This is the last chapter of the 9 chapters on investing. So, why do I not use a personal finance advisor? Well, let's kind of have a look again at this formulaic approach to what this is a model-based approach to investing. We've been talking about models and measurements all throughout the past 9 chapters. And so here's a model for what investing may look like. Let's say you can put $7,000 per year into your investments, and we're going to grow them at 10.5% per year for 35 years. Remember, that's the S&P 500 with reinvested dividends has grown at an average of 10.5% a year. So we're going to put in $7,000 in the first year, and the next year we're going to increment that by 2%. So $7,140 the next year, and then grow that by 2%, and so on. That's just keeping up with inflation is what we're doing there. And so, and by the way, the maximum you're allowed to put into your IRAs today is 7,000, but they generally are incrementing at the cost of living. So you do this formula, do all the math, and you'll have $2.5 million invested. I think having $7,000, finding that in your average starting salary as a college graduate, an average college graduate, I think hopefully can find that amount of money to invest. And you see that just being steadfast year after year after year, not chasing after things you might have fear of missing out after, but just investing steadfastly, going after funds that invest in the S&P 500 and reinvest your dividends, you can get to the 2.5 million, $2 million mark, which was our goal. But if you pay someone to manage your money for you, they typically charge about 1%. Financial advisors charge about 1% of all the monies that you have invested that they are managing for you. And so they got to get paid, and that's what they do, typically about 1%. We've already learned that it's hard for mutual or for funds, ETFs and mutual funds that are actively managed. We've already learned in the fund conversation that it's hard for those active managers to match the S&P 500 with reinvested dividends. It's hard for them to do that. So imagine here we have a financial advisor who's already taken 1% away from you. In other words, it's going to be pretty difficult for them to overcome their fee. We've already seen that, and you can read about that in the book. So, well, how much worse will you be for paying a financial advisor? You'll hit $2 million, $500,000 less. This is deeply challenging. That's how much it costs to have a financial advisor in this model-based example. How about an actual data, a measurement-based example? So here is the S&P 500 with reinvested dividends starting in 1989, going all the way to mid-2024. And you get to follow, if you're doing your own investing yourself, you follow the blue line. And we've seen this in one of the previous plots. But this is when we take $7,000 annually increasing it by 2%, we get to grow to 2.8 million. Maybe I haven't shown you this plot yet. I think I have, but in any event, here it is. That's what would happen with actual measurements. And the total invested amount of money is $363,000. This would be really fantastic. You get to close to $3 million. If instead you were paying your advisor to do this for you, you were still putting in your own money, but they were taking out 1% a year. Well, that's right here. These little dots right across through there, you barely even see those dots. Doesn't look like much. If we add up all the dots, just the dots themselves, we add them up year after year after year, we get to this line, and the total cost would be $176,000. You might think that would be worth it until you realize that $176,000 was not invested for you, and therefore you lost out on this line. That's how much money you're actually losing because you're not getting that dashed line invested for you. And what's that cost? $589,000. You can't afford that. That's how much, in other words, by learning personal finance, by learning how to invest for yourself and building your confidence to do this yourself, you are saving hundreds of thousands of dollars. You're literally, in that sense, paying yourself. Now, I think I did show you this plot. This is the one that I think I did show you before. A 50,000, that was a annual allocation of monies for 35 years. Let's do a lump sum. Let's say back in 1989, you could come up with $50,000 and do a lump sum one-time investment. You would follow the blue line and get to $2 million after 35 plus years. But if you paid the advisor, you'd go far less. How much was that cost? Again, you can't even see these little dots. They don't look like much of anything that you're paying the advisor on a quarterly basis. Summing it all up sums up to $132,000 in a loss, actually, because you didn't weren't able to invest that money that you paid your advisor. That was a $583,000 that you did not make. Oh man, this is really challenging for us. In other words, I think you can literally pay yourself hundreds of thousands of dollars to learn how to do this yourself. Now, what you will hear on those TV commercials where they'll be talking about financial advisors, they'll say, "Hey, we only make money," or radio announcers, the radio commercials, I should say. They'll say the financial advisor will say, "I only make money if you make money." That's kind of, but they fail to tell you that they also make money when you lose money. Let's do a close up right here. We're going to do a close up right there of the lost decade. We're just going to zoom into that and have a look at that next. So if you were investing yourself from 2000 to 2011, if you were investing yourself and not paying an advisor, you follow the blue line. And you see, okay, that's the lost decade. You didn't make much. From C to D, you only made 21,000. Okay. It's sad, but then everyone was in the same boat. But how about if you were paying someone? You start off at A and you end over here along the red line at B. You lost $15,000. The running sum of those fees, how much were you paying the advisor? From E to F, you paid the advisor $27,000. This person along the red line not only lost money, $15,000, they paid their advisor to lose money. That's deeply troubling to me. And you don't hear about that in those ads and so on TV and on the radio. So what are the funds that I own? I often get that question, and I get it. Sometimes we just like, just tell me the answer. And I understand that. I do that kind of thing myself from time to time. So here are the funds that I own. You see them numbered through here. I own SCHB and SCHD. I also own VTSAX and VTIAX. I don't know that you actually need international funds. You'll see in just a minute, I have a very little bit of money in those. Then inside my 401k, there are proprietary funds inside of my 401k that follow certain indexes. You see the indexes over here that these funds are following. So if you wanted to buy the same funds that I own in my 401k, I would suggest you buy these funds that you see listed there, Vanguard or the Schwab equivalent. And I'm sure Fidelity and others have their equivalents to this. You just got to go find them for which index they are following. So that's what I own. And then the final question to sort of have a look at is, well, how much percentage-wise do I have in each one of those accounts? So in my SCHB, which is a broad market fund, I got close to 60% in that. And then you look at some of the other equity funds, you add up all the equity funds, I have about 81% of my investments in equity funds, and then in bonds, and then this thing called a real estate investment trust, which behaves like a bond. I have about 20% in that. So that you can get an idea of the ratios. And this is if I put all my monies in Schwab accounts, or in not Schwab account, well, in Schwab accounts, but with Schwab funds, or in a Vanguard funds over down through here. So conclusions to this chapter. Personal finance advisors typically charge around 1%. And over decades of investing, that fee can cost you hundreds of thousands of dollars. If you want to know how valuable it is for you to spend the time to learn how to do your own personal finance, it's literally hundreds of thousands of dollars. It's really worth it to you to learn. One of the most important things you can do is read books. And I've already recommended 4 books. I keep recommending this book by Burton Malkiel, A Random Walk Down Wall Street, particularly when it comes to investing. It's an incredibly important book for you to read. When you read and you learn, you build your confidence that you know what you're doing, and you'll begin to understand so much more about your own investing. I think you could actually just focus on these 3 funds if you wanted to, or you could find this equivalent to those 3 funds. You could find their equivalents in Vanguard and Fidelity. Whew. Now let's wrap up if there's just one PowerPoint for all 9 of those lectures, all 9 of those presentations on investing, it would be this PowerPoint. Open an online brokerage account with Schwab or Vanguard, whomever you think is ideal, but make sure it's a major player. Fidelity's another good choice. Buy a passively managed fund with low fees and low turnover. The fund should follow a well-known index such as the S&P 500. Reinvest those dividends and hold it for at least 3 decades. Buy and hold it. At least three decades, probably 35 years. You can definitely do this. You're very capable of doing this yourself. Buy the maximum amount allowed into your IRA. Maybe max out your 401k if you can. And keep increasing that 2% a year, however much you can increase that, keeping up with whatever limitations are on the IRA. Try to max out your 401k. After you've filled those out, any extra monies, go ahead and put them in a taxable account. You might actually want to have a little bit more of a balance. Maybe you don't max them out, and you might want to have some monies in the taxable, but do your best to really fill up those tax deferred accounts. They're highly tax advantageous for you. I want you to also buy a bond fund. Here's a suggestion. Typical equity to bond ratio is about 80% of your money's in stocks and 20% in bonds. You might go 90 and 10. Something like that is typical for starting out, and then adjust to your risk tolerance. Buy a bond fund rather than individual bonds. Maybe once you get better at understanding the basics of investing and you move beyond that to becoming more comfortable with it, you might invest in individual bonds, but you don't necessarily need to. Control what you can control. You can control fees by avoiding them. Don't pay a personal finance advisor. Do it yourself. Using long-term capital gains taxes, investing buy and hold techniques, investing in your tax-deferred accounts. That avoids taxes as well. Check your emotions. You figure out when you want the money. If you're saving, if you're investing for your retirement, don't suddenly cash it all out to go buy a house. And of course, your equity bond ratio, that asset allocation, that's in your control as well. These are all things that are in your control. And as a reminder, as I've reminding you throughout the book, I don't know what will happen in the future. Absolutely no one can predict the future. No matter what you read online, it is impossible to predict the future. You can guess at it, but then you're not going to be accurate. These are recommendations, not promises for the future.